So we've had a lot of people up here talking about where they think the price of gold is going to go. Maybe copper, silver, those are all great metals. We're here to talk about bringing the next major gold mine into production. Seems to me that bringing a big mine into production at just the time that the price of the metal goes up is a good idea. Two years ago, we issued a preliminary engineering assessment on this ore body. It was followed by a pre-feasibility study, and at that point in late 2018, we issued a notice that we had 4.7 million ounces reserve. Through completion of the feasibility study, which was issued in October of 2019, we're now 5.1 million ounces. Over that period of time, we've also configured the company to get ready for capital decision to bring it into production, and we're currently involved in the advancement of engineering to reach that objective. I'd like to bring to your attention just some of the people that we have brought into the board in the last year. We've got Trevor Schultz on the lower left side there. Trevor has about 10 years experience. Well, he's got a long career experience building several mines around the world, specifically about 10 years working in Ghana. Ken Thomas is a person that I've worked with myself over the last 25 or 30 years. He's very well known as a former senior VP with Barrick. Ken was the guy on the technical side that brought the autoclave into the gold business in the late 1980s and early 1990s. I can't tell you what a pleasure it is for me to have the opportunity to work with Ken on an ongoing basis. I'm Dave Anthony. I'm the Chief Operating Officer for Cardinal. My own experience exceeds about 40 years in the business. I've been building mines around the world for pretty much all of my career, and that includes 2 mines for Barrick in Tanzania. I also ran a group of 4 mines in Tanzania for Barrick in a company that was once called African Barrick Gold. And I was part of that leadership team when we brought the IPO through in 2009. John Grigorchevich is our Chief Financial Officer. Again, he's got a long track record with bringing mines into production in the minerals sector. I'm not going to spend a lot of time talking about who's on our asset register, but it's in our brochure that's available if you come and visit us over at the booth. Just to give you an idea of where the project is located, it's in the north of Ghana. We have a significant land package in the north of Ghana, and it's also a place where, I've been to sites several times. When you go to some of the sites that I've been to around the world, you look at significant costs to deal with logistics, infrastructure, power. These aren't significant factors for us. We're located very close to a power line. We've got good access to water. There's an international highway runs right past our mine site, and the ground is such that building is not a geotechnical issue. It gives a good opportunity to control costs. Just to give you a look at where things stand coming out of the feasibility study, 2 points of interest to people in the gold business. Number one, as I mentioned before, we will we do have a 5.1 million ounce reserve, and over the course of a 15-year mine life, we'll produce just over 4.1 million ounces. What that means in terms of free cash is that in 15 years, at today's prices, we will produce $2 billion. Just equally important is that our starter pit, which is about 2.3 years, produces 360,000 ounces per year, and we've got a payback of about 2 years at today's prices. This is the 4th iteration of our mine plan. So we're starting to get to a high level of detail, a high level of confidence on the mine plan. One thing I'd like to point out is that at about year 9, we have a drop in production as we go through phase changes on the pits. as we get later into this discussion, we'll talk about the opportunity to bring satellite pits into production and smooth out that production profile. I think we talked a little bit already about some of our feasibility study financials. We designed the pit at $1,350 an ounce. Today's price, I think most people are aware, is about $1,560. The starter pit has all-in sustaining costs around $600 an ounce, and life of mine we're at about $900 an ounce. I think you can take a look at there and see that the other financial metrics are very substantial. At $1,350 an ounce, we have a 33% post-tax IRR. At today's prices, it's closer to 50%. And you can just see some of these sensitivities here. The red bars represent the $1,350 an ounce range, and then obviously on the left-hand side of all of these charts, we see where we would be if we went into production today. Just referring back to the gentleman that spoke before us, if gold goes higher than this, obviously the returns become spectacular. And again, some more financial metrics. Just like to talk about bringing this project together. In the junior mining space, it's very, very unusual for companies of the stature of Cardinal to be able to engage Tier 1 partners. I personally have built mines with Lycopodium. They're just excellent people to work with. They're considered top shelf in our business. Golder, I think, has a reputation that most people understand quite well. Everything they do is very thorough, very detailed, and rigorous performance. Knight Piésold has been one of my favorite partners in the field for years. When I go to a site with Knight Piésold, not only do they provide me with the design that meets all international standards and is robust, generally when they get to site, they show me how to take money out of the budget. If you're a project developer, that's always good news. Talk a little bit about flow sheets. My background as a mining engineer is I tend to go on and on about flow sheets. Most people in the audience tend to fall asleep, so I'll try and keep this brief. The front end of this plant treats 9.5 million tons per year. The back end treats 700,000 tons per year. What that means is that we end up having a plant that costs much less than it would if we just treated 9.5 million tons a year from front to back. We'll get into CapEx a little bit later, but we're actually looking at around $400 million to build a 9.5 million ton a year mine. Contemporary costs suggest we should be about $600 or $800 million. Just looking at some of the cross sections on the geology, you can see where the starter pit is. It's a nice tidy shape. The ore body is very homogeneous, and this allows us to get into the ore straight away without a lot of working capital. And it gives us assurance that our starter pit with the 2-year payback is going to deliver exactly as we say it should. And again, more geology. I talked earlier about, I see I have a minute left, so I'll try and speed it up. I talked earlier about the potential for satellite pits. You can see the location of the Namdini mine is down in the lower right-hand side there. If you go straight north of that, about 20 kilometers, we get into the Ndongo exploration site. You can see some pretty handsome grades there. For me to truck ore of that quality 20 kilometers really gives us the potential to extend our mine life, and we're very excited about it. And as well as that, you can see we have a significant land package to the north and east of the mine site. Where we are right now is, as I mentioned, we're advancing the front-end engineering and design. That'll take us through the first half. It'll increase the level of engineering and reduce the level of risk associated with project execution. We expect to start construction in the second half of this year, and we're looking at around 30 months to bring this mine into production. So by 2022, we should be making upwards of 350,000 ounces a year for the first 3 years.